Four of the best utility stocks to buy now for reliable, continuous dividends. We're going to take a look at each one. We're going to look at the historical performance. We'll look at their dividend safety. We'll run through their financial metrics. And as always, we will put them through the valuation model, getting to our intrinsic value, finding our acceptable buy price, given that investor margin of safety. And as always, we'll look towards Wall Street to see what they forecast over the next 12 months. So let's get right into it with stock number one. We have NFG, National Fuel Gas Company. Now over the last year it is down 17.5%. We can see it trading towards the lower end of the 52-week range. Its yield is now over 4% and a forward PE below 10. And over the last 10 years, if you've been holding this company, you can see that you would be down 36%. Bear in mind, it doesn't include those dividends reinvested. And we see its all-time highs in May 2022 at around $75. So let's take a look at this company. Dividend safety score 95. It is very safe. Market cap $4.5 billion in a mid-cap company. In terms of recessionary metrics, for those that see a recession in 2024, while they increased the dividend in the 07-09 crash, they had below average growth. S&P 500 07-09 was negative 12%, but they did outperform the S&P negative 40% return versus the S&P's negative 55%. Dividend growth, well, last summer, June 23, 4.2%. Not too bad. That is pretty much what I always advocate to get as a minimum, around that 4% to keep up in line with inflation. Slightly lower over the last 5 years as well as the last 20 years. And if we look at the dividend growth, they have been increasing those dividends for the last 53 years. Hence, they do have that dividend king status. And they've also been paying dividends for the last 122 years without a reduction. So let's take a look at dividend yield theory. Now it states a company is undervalued when the current yield sits above the 5-year average. 4.08 versus 3.56. We have our first sign there of undervaluation. And our second sign here, forward PE 9.5 versus the 5-year average of 11.8. But do always bear in mind, we never look at any of these models in isolation. We will conclude towards the end. We can also see the utilities sector PE is significantly higher at 15.5. So let's take a look at the payout ratio. Now, typically on the channel, we do like to focus on the free cash flow. However, for utilities, it is a lot more volatile, so we do draw your attention to the earnings payout. Below 75% is the blanket rule for utilities company. Nice to note for NFG, it is consistently below that. 38% in 2023, 39% expected in 2024, so no real worries there. Earnings per share, it has been increasing, 343 in 2014, 517 in 2023. Now look, there have been some long periods where it has been pretty flat from 2014 to 2019, although over the longer term it is moving in the right direction. 2024 though expected to be pretty flat as well from 2023. In terms of top line growth, again, it is a very cyclical industry, so we do see double-digit growth followed by double-digit negative growth continuously over the cycle. 2023 down 1% in the latest year, and numerically speaking it is a lot clearer when we see the numbers. 2 billion in 2014, 2.2 in 2023, so relatively little movement, although that is because when you break it down you can see the cycles of negative growth and increased growth. Shares outstanding, whilst we love share buybacks as investors because it essentially returns excess cash to our pockets, what utilities does is the opposite. They issue shares, so they dilute your position over the long term. 85 million in 2014, 92.3 in the latest report. So the reason for this, for those that are wondering, is they have to issue equity to fund a portion of their growth expenditures as they pay the majority of their earnings through dividends. Now, when we take a look at the ROIC, what I quite like to see, 10%. However, we can lower this to 7.5% for the utilities industry specific. Double digits though from NFG, very, very positive. This does help when analysing management as one of my investment thesis sectors, because essentially it shows me they are able to effectively allocate their capital. 11% in 2023, looking very positive. In terms of the margins then, we can see operating margins above that minimum 18% that we look for utilities. And on top of that, it has been increasing over the longer term. 35% very solid in 2023, and the last few years have been at a similar rate. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the balance sheet strength as well as dividend safety. And what these are the number of years it would take the company to pay off all of their debt net of cash on hand. 2.26 in 2023, 2024 expected to go even lower, so we can see not only their balance sheet is looking strong based on this information, but also we understand why that dividend looks to be very safe. So let's get into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do deep dives of stocks and we run through every single one of these models. For today's episode, let's get straight into the final intrinsic value calculation. And for today's episode of NFG, it comes to $65. So we start off with a margin of safety of 10%, which we use if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to $58. We keep going until we get near enough the current trading price. And what we can see is it pretty much bang on a 25% margin of safety at today's value. In terms of Wall Street and what they forecast over the next 12 months, well, they see upside of just under 30% with a price target of $63, not too far off our intrinsic value. As always, let us know your thoughts in the comments below, whether you have been adding any of these companies we're running through or if you're adding them onto the watch list. We then move on to the second stock, which is AEP, American Electric Power Company, down 15% over the last year, again trading towards the mid to lower end of the 52-week range. Over the last 10 years, however, you would be up 53.5%, and again we can see they have hit its all-time highs a few times, just over $100 over the last few years. It does have a current yield of 4.5% with a forward PE of just under 15. Another very safe dividend score of 81, 41 billion market cap, a large cap company. And when we take a look at those key recessionary metrics, well, they maintained the dividend during the last recession. They had above average growth, and they also outperformed the S&P with their recession return. Dividend growth, nice to note, 6%, quite healthy for a utility company last October. 6% on average over the last 5 years. A little bit worrying that over the last 20 years it's 1% per year on average, but it's nice to see the more recent increases are nice, healthy single-digit increases. Dividend growth, and they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, looking severely undervalued here, 4.54 versus 3.45. Likewise on the forward P, 13.9 below their 5-year average. In terms of the sector P, they are slightly lower than utilities as well, of 15.5. So let's take a look at the earnings payout. Again, consistently below the 75% year on year. Pretty consistent, in fact, around the mid-60s. 2023, 66%. 2024 expected 63%. So let's take a look at the earnings per share. Increases nearly every single year, going from 323 to 509. Nice to note that 2024 is expected to go higher to 557, although we can see 2023 is expected to be flat from 2022. In terms of sales growth, again, whilst this is a cyclical industry, it is nice to note it hasn't affected them as much as the previous company we analysed, NFG. With the last 2 years, strong double-digit growth, and we note, however, 2023 expected is 2%. So numerically, it has gone from 15 billion to just under 20. Shares outstanding as well, whilst they do increase and dilute your position over the last 10 years, it is at a fairly slow rate, which is nice to note for this utility company. ROIC a little bit lower than NFG, as we can see it isn't double digit, in fact pretty consistently over the last 6 years at around that 5% to 6% level. In terms of the margins, very nice, it is above 18%, pretty consistent as well, whilst it does straddle around that a few years of the last decade. It's nice to note that over the last 4 years it has been in the 20% to 21%. Net debt to EBITDA, one area probably just to keep an eye on, whilst 5.5 is the maximum we like to see. 2022 and 2023 expected is over, although again just keep an eye on, but 2024 at 5.2 is nice to see it lowering down, although that is purely just expectation right now. So let's get into the valuation of AEP. And as always, if you want to grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or on your watch list, you can click on that pinned comment below. Starting off then with a margin of safety of 10%, as we always do, we see a buy up to 82.32 at 15%, pretty much bang on the current trading price, not too far off. So for AEP, we see a 15% margin of safety on the estimates and judgments. In terms of Wall Street, well, their price target is $88. They do see upside of 13% over the next 12 months. So similar to NFG, they do believe this as a buy, although as we can see, there was a lot more upside on the National Fuel Gas Company stock 1. Now, before we move on to stock number 3, just to let you know, we have a free weekly newsletter that drops every Friday. If you want to grab a copy completely free, click on the pinned comment below. Our latest article, we discussed insider buying and selling of companies by management over the last few weeks. And within one of our articles, we also discussed our 7 golden dividend metrics on how to identify undervalued companies. So the third utilities company we're taking a look at is Pinnacle West Capital, PNW ticker symbol, down 9% over the last year, again trading at the mid to lower end of the 52-week low, yield over 5% and a forward PE just under 16. If you've been holding this over the last 10 years, you would be up 24%. Not the greatest, although it doesn't include dividends reinvested, and its all-time high sits around $104 pre-pandemic. Dividend safety, another safe score at 70, market cap $8 billion, just a mid-cap company. And when we take a look at those key recessionary metrics, they maintained the dividend during the last recession. Average growth, but they did outperform the S&P negative 40%. Dividend growth, whilst it was fairly slow in October 23 below inflation, on average over the last 5 years it is at 5%, and on average over the last 20 years it is at least keeping up with inflation. In terms of their growth streaks, well, they've been increasing those dividends for the last 11 years. So let's take a look at dividend yield theory, another strong sign of undervaluation both on the yield as well as the forward PE. Sector PE, though, it is near enough to the utilities sector at 15.5. Looking at the earnings payout, remember below 75% is what we want to see. Now 80%, a little bit too high in 22 and expected pretty similar in 2023. Although nice to note it is coming down in 2024 to that 75% level. Earnings per share, whilst it did increase for the majority of the last 10 years, we did see a drop in 2021. Now 2023 is expected to be flat on the previous year, although in better news, management are guiding 471 for 2024, so they do expect an increase from 2023. Sales growth as well, pretty much one of the best growing of the 3 that we have just reviewed. Only 1 year of negative growth, and over the last 4 years it's looking like some healthy increases to their top line, double digits over the last 2 years, and we can see it has gone from around 3.5 million in 2013, billion in fact, to 4.71 expected. Also, they don't dilute your position that much. In fact, over the last 10 years, they have only issued around 3 million worth of shares. So again, looking very healthy. ROIC, now this is one thing that I'm not particularly keen on when we see it decreasing over the longer term. 4% in 2023. If you did read my newsletter, my article around the 7 golden dividend metrics, you know that we don't want to see it decreasing. If anything, consistency is better than to see it decreasing. So somewhere just to keep an eye on moving forwards. You don't want it to go even lower than that 4%. Operating margin looking healthy, is around that 18% level year on year. Again, this has been decreasing, so possibly one area just to keep an eye on in 2024 and beyond. Net debt to EBITDA in better news, whilst in 2023 it's expected to pretty much be bang on our maximum we like at 5.5. 2024 they are anticipating this to come back down to the level seen in 2022. So how about the valuation of PNW? Let's jump into it. So for today's episode, we get an intrinsic value of $75. So we start off with our margin of safety at 10%, and it's pretty much a few cents shy from the current trading price. So for PNW, we see a 10% margin of safety. In terms of Wall Street and their forecast over the next 12 months, their price target is $78, and they see upside of 14%, bearing in mind you are also getting a healthy starting yield. We then move on to stock number 4, one of the more popular utility companies, ticker symbol SO, the Southern Company. They are up 2% over the last year, trading in the midpoint of the 52-week range, a yield just over 4%, forward P below 19, and over the last 10 years you would be up 61%, and we can see their all-time highs around that $80 mark in 2022. Dividend safety score 65, it is safe. Market cap 75 billion, a large cap company. And when we look at those recessionary metrics, well, they increased the dividend during the last recession, average growth, but they significantly outperformed the S&P with just a negative 23% return. Pretty consistent, although not too sure that's something to gloat about. 2.9% increase in April last year, 3% on average over the last 5 years, 4% on average over the last 20 years. And we note they have been increasing those dividends for the last 21 years. 4 years away from becoming a dividend aristocrat, 75 years of paying a dividend without a reduction. Dividend yield theory, then, we can see a sign here of reasonable valuation, 4.1, bang on the essential 5-year average, although we note the forward P sits lower than the 5-year average of 18.7, and we can see Southern Company is higher than that sector PE for utilities. So let's take a look at the earnings payout. Pretty consistent around that 75% nearly every single year. We do note 2023 did go high at 85%, although they're expecting this to come back down in 2024 to 71%. Earnings per share, consistent increases year on year, although 2023 we're expecting a dip, and they are expecting in 2024 for this to rebound significantly to just under $4. Sales growth then, again, the cyclicality and volatility of the industry, although 2021 and 2022 saw double-digit growth to the top line, 2023 unfortunately negative 6%, and we can see numerically 17 billion in 2013 to 26.3 expected in that latest report. Shares outstanding, very typical, as we mentioned, it has increased over the period, currently sitting around 1.1 billion. So looking at the ROIC, very inconsistent and unfortunately below that 7.5% that we look for year on year. 2022 at 6%, 2023 at 5%. Operating margin, whilst it is inconsistent for the majority of the last 10 years, looking healthy. 2021 and 2022 and 23 around the 21% mark, looking very strong. Net debt to EBITDA then, 6.5 in 2023. Now this is why we did see that lower safe score on the dividend safety compared to the other 3 stocks we initially spoke, due to the fact that they have a high debt level, 6.54 in 2023, 5.48 in 2024, just below that 5.5 level. So let's get to the important valuation of the Southern Company, and in today's episode it is the average of these 3 models, and it comes to a total of $74. So in terms of the margin of safety, we start off, remember, that 10%, and we can see again around $1 shy, so we see 10% margin of safety for Southern Company. In terms of Wall Street over the next 12 months with this company, they do see a upside of 9%, price target $74 over that 12-month period. As always, if you enjoyed today's episode, smash that like button. If there are any other industries that you believe are significantly undervalued or have some nice upside, let us know in the comments below. And as always, have a great day and see you on the next one.